Welcome to Fast Market. It's Friday, February 15th. I'm Tom White, and I'm joined on set by the co-host of Fast Market, Kevin Hinks, and also joining us today is Larry Shover, CIO of Efficient Advisors. Welcome to the show, Larry.
Thank you.
Welcome back. Good to see you again.
Thank you.
Hey, guys, we've got a rally going on.
A fangless rally.
A fangless rally, because a lot of the Fang Plus names are down. But Larry, your take on this rally, is this more of a hope-timism rally, or is this based on the fundamentals and the economic data we've seen? Because yesterday it seemed like there was a cloud over the markets due to the retail sales number, and today it's been forgotten.
Yeah, in short, it's performance anxiety, it's chasing. I mean, fundamentals take the S&Ps up to maybe 2,700, maybe 2,750, but now that we're starting to get above that, I think performance anxiety, position and sentiment takes over. And make no mistake about it, we know that position and sentiment can cause a market to overshoot for a long time.
Kevin and I talk about that all the time.
Yes.
Overshooting to the downside, on the upside. Things get overbought, oversold.
Is it, guys, though? Is this the incremental release of China discussion?
Yeah.
Right? That's really taken the move. This is the China move. I think you're getting it right here.
Are we
right?
buying that rumor right now? Is that what the
Exactly.
market's doing? Buying that rumor that the negotiations between China and the U.S. as far as trade goes is going positively. They're going to start talks up again next week. I guess some officials are coming in from China to D.C.
They're wearing out the frequent flyer miles, aren't they?
They are.
We go there, then they come here like 3 days later.
Right.
Yeah.
But the way that I look at it is it that the fear of missing out, like you mentioned, Larry, the getting overextended a little bit. This market, S&P 500's up over 10.5% so far this year.
That's
Russell 2000 up 1.3%. So the small caps are participating, leading the charge, up 6 days in a row, and the market's following it. In every asset class is up, Larry. What breaks?
Yeah, what breaks? And I keep looking at earnings multiples, right?
Yeah.
Something we've talked about here forever.
Right.
And I think the market's like pretty happy, pretty content with placing a 16 times multiple on what we just saw. That would take us to where we are right now. Could it go to 16 and a half? That would take us up to maybe 28, 30. Sure, why not? But I just think it gets more complicated up there.
Especially with a lot of the corporations, we're getting towards the end of earnings season, and a lot of the guidance hasn't been as robust as in quarters past, but that typicically happens coming off such great numbers that we saw in 2018 on the corporate side, Kevin. But does that equate to a forward-looking PE on the S&P 500 being above 16?
No, I want you to ask me the question. What breaks? What breaks?
What breaks, Kevin?
VIX breaks.
VIX breaks. It's
Right.
already broken.
Exactly.
It's down to 15.
Exactly. VIX. What you have to be careful here is you have to make a decision on volatility, right? Because as you get to late February and early March, people start looking to spring. And the historical implied volatility, you can see the trough and how long it spends
Reversion
down there.
to the mean right there,
Exactly.
Kevin.
Do you think it's too cheap?
If it gets to 14, 13 in this type of environment, maybe. I think.
It depends. Well, it's easy. Are we near a top? If we're near a top, it's way too cheap.
Right.
All right. If we're not near a top and this market starts to grind higher, then we're not.
So how about like interest rate volatility? Look at the MOVE index, et cetera. I mean, relatively speaking, interest rate bond volatility is much cheaper than the VIX is right now.
And we've seen that bid into treasuries. Kevin and I talked about that, or hit on that yesterday. In every asset class, gold's up, the dollar's up,
Oil's up.
treasuries up.
Yep.
Commodities up, and stocks are up. And that's why I kind of posed that question. It's like, what breaks? What's going to break in this market? Is it all clear for equities, where you're going to see that pullback in treasuries, or is it the other way around, where equities are getting a little bit ahead of themselves, just like they did last January before the sell-off in February?
Yeah.
But that being said, valuations are a little bit lower than they were last January on a forward-looking basis, right, Larry?
Yeah.
Look at this chart on the screen, guys, and tell me what's going on here. The inverse relationship between the U.S. dollar and gold has turned to a positive relationship.
I know. That's what's,
gold going up as the U.S. dollar going up. Someone explain that to me.
Yeah.
But is somebody out there going into the safety of buying up gold a little bit? The central banks bought more gold over the last several months than they have since the end of World War II.
Yes. I read the same thing.
What are they expecting?
I read.
Is somebody
gold.
covering the fact that, hey, I've got to be a little bit more nimble here, and I'm going to go into some safety plays. The U.S. dollar right now, kind of a safety play. Treasuries are still bid up, even though equities are rising, and then you're getting that move into gold also.
Yeah, and to add on top of that, safe havens. When you look at the currency markets, you're seeing the yen and Swiss franc. People, selling that, buying the high yielders, New Zealand dollar, Australian dollar. I mean, that's a safe haven play. The squeezing out yield where you can, and it's good until it doesn't work anymore.
Exactly. We've seen that a lot in the markets, being ex-market makers. It works until it doesn't.
I've identified a rare correlation here, and that is the last day that is correlated.
That's right.
Now, that's what I'm a little bit afraid of, that you're going to start getting that fear of missing out trade, where people are starting to sell puts again, getting comfortable with the rising equity markets. And we all know what happened in February last year, in April, in October, in December. They got kind of destroyed on that type of trade. So
if this market doesn't break, if it stays here or higher the rest of the day, there's going to be a 14 handle on the VIX.
Oh yeah,
by the end of the day.
I would expect so. I know that the president's talking right now about signing the deal to not shut down the government, and also national state of emergency. So we'll have to watch that, see if that creates any volatility. But let's move on to the economic data, guys, because pretty solid numbers.
Pretty good numbers. Everything except
go ahead.
Industrial production.
Yeah, that was down. That was a big miss. Now this is a January number, right, Kevin? It plunged 0.6%. Month over month in January, downwardly.
Manufacturing down 0.9.
Yep.
And the capacity utilization rate, 78.2. 3 misses.
Yeah, that was a miss. And the decline was driven, from what I read, by an 8.8% decline in motor vehicle sales and parts, and assemblies falling. So, maybe some pullback in production along those lines. But that's not and we've got a chart on this, Rob, if you want to bring it up. Industrial production rates, they've been moving higher over the last 20 years. But then look at the stock market, how much it's above it. And this was out on zero hedge. So I thought this was kind of an interesting chart. The dispersion
That's
between
what we call
two.
Divergence.
Yep.
Yes.
Right there.
Dispersion, diversion, yes.
And industrial production definitely is a moving target. Huge correlation to the market. We'd all agree with that. But if it's plateauing at a high level.
Right.
That's one thing we have to keep in mind.
Right.
Kevin and I talked
diminishing returns on the ability for it to go higher.
Kevin and I talked about that. That last year, the numbers, economic data was so good for most of the year, but. Now you're coming back down to more normalized, historically normalized levels, and people aren't comfortable with that. I think that's why you've seen that added volatility in October and December especially. But as far as the other numbers go, Kevin, consumer sentiment was a beat.
Nice beat, 95.5 on consumer sentiment. Empire State, a regional look at manufacturing. Big snapback. Remember, it was a bad miss a month ago.
Big down
to 3.9. Now spikes up to 8.8.
Yeah, new orders improved on that one, but prices paid declined. So that gets into that discussion about inflation not taking hold yet. And
that's right.
Going back.
We saw that in the import prices today, and hidden. I mean, it was a small miss, right? No big deal. But beneath it all, what's troubling is that all the subcomponents were down. And take oil out of the equation, because everybody's like, okay, of course, oil's down. Import prices down, et cetera. You take oil out of the equation, it's the steepest drop we've had since January of 2015.
Yeah, and energy prices have been the outlier on a lot of this data, right? And it's actually made these numbers almost Goldilocks numbers. And I think that consumer sentiment was a perfect example. Empire State, they snapped back from hitting lows last month, but those are like Goldilocks numbers, and the Fed's probably looking at that going, okay, that's fine. After looking at the retail sales data yesterday, probably scratching their heads on that one a little bit. But all in all,
so at the end of the day, what are we talking about? Mixed numbers, right?
Mixed numbers.
No clear everything melting up. That retail sales number was alarming in its weakness.
Yes.
And yet this market, this Teflon market that seems to just have, even the selling that started Yesterday's trade couldn't hold.
Yeah.
Yeah, and look at like the yield curve. You'd think that would have
Yeah.
collapsed yesterday.
Yeah.
The 210, I think, went in the 13
Oh, I mean,
bips or
bonds
something.
rallied early, but then backed off
Yeah,
pretty
I mean-
significantly.
Yeah, and bonds were down this morning. They've snapped back. They're basically unchanged right now. You got that 10-year down at 2.67, and we found a sweet spot for that 10-year in yields right now because they've been pretty consistent over the last several weeks at low levels under and around that 2.7% level for the 10-year. But we'll have to wait and see because I still think something's going to crack in here. If you have the dollar up this high, I think you're going to start seeing currency headwinds out of some of these companies.
Well, you're
moving
already
forward.
seeing that.
Yeah.
Some people are talking
But
about
I think
it.
that the rhetoric or the alarm bells
Here's
are
the
going to
question.
sound.
Coke had big currency headwinds. Pepsi, not so much.
Yeah.
I wonder why that is.
Well, I think it's due to their snack business, I think, a lot, and that's more domestic based than the beverage
and how about
business.
Pepsi? Higher with increased spending and kind of lowered guidance because they're investing in the business.
Well, we did
And
see
people
that
thought
pullback
is
in
positive.
Pepsi yesterday
Yeah.
based on or on the back of Coca-Cola falling like 7% yesterday. But let's get into that discussion, Kevin, about Pepsi because we looked at this stock going into earnings.
nice day here.
EPS was a meet, $1.49 a share. Q4 revenue a little bit light, basically in line though. Cost-cutting plans, plant closures. I think that's what's boosting the shares right here.
Let's put it this way. I've traded Pepsi since the Reagan years, and there's not a lot of days where this stock gaps like that and moves
Is that
higher.
right?
Yeah,
It
it's
is
just
more
not
of
a
a
very
trend?
volatile stock.
Yeah, and I think the anticipated market maker move yesterday, and there was plus or minus $3 for this stock. So it's right there. It's moved one standard deviation higher. But I think part of that, Kevin, is due to the fact that it was sold off nearly $2 yesterday. So basically up about $1 if you take those out. Now, we did a couple example trades in there. We have the 115 calendar on in Pepsi, Kevin, that we did. Which is trading the stock's trading just above that. And we also did a double diagonal. We've got a working order in there to roll our short 113 straddle that we sold in the near term. We're going to roll that into the February 22nd weekly, and we're long the 110 puts and 116 calls against that. And we did that for a $1.81 credit. But working that 113 put straddle, or the calls and puts a straddle, we're trying to roll that into the next weekly series, take some credits in, reduce our exposure on that. But then 115 call calendar, Kevin, what do you got on that one? Because we're right there on the calendar. So we paid 49 cents for this, Kevin. What do you do on something like this? Or no, we paid 15 cents. I'm sorry.
15.
15 cents.
Yeah, so we have a nice triple here.
Nice
Now it's like a
triple.
50
What do you
cent
do?
credit.
Like, Larry, when you're managing trades, you do an earnings type of an example like we did here. Do you close it? Do you try to adjust it? Or what do you do?
Have you just tripled your?
Yeah.
Absolutely, 15 cents to 50.
I mean, you have to let your winners ride, but boy, that's like
That's a nice
That
triple.
is
That's a nice triple.
We're in the moving business, not the storage business.
Exactly.
That's Kevin.
You get to move to your strike. You get to move to your strike. Take it.
Take
Because
it.
guess what? If it goes up another $1, now it's moving away from your
Right.
strike, and you could get hurt on this. So
Right.
you'll start
You
giving
hit
it back.
I mean, how much more are you going to?
And think about this, guys. If you look at the 115 calls that were short in there, and the Feb 115s, Kevin took that off already.
Right.
You've only got about 18 cents of premium left in those.
That's not worth it.
That's a close, right, immediately.
Yeah.
And then we're working to roll that short straddle, and we'll do that before the end of the day. Now let's move on to John Deere, another company that
Yes,
reported
love
earnings
it.
this morning. It's a good barometer for the overall global economy in a lot of ways. A little bit more agricultural based than Caterpillar. Caterpillar's up pretty strong today, leading in the Dow. But we did the 155 put. Now this one looked good, Kevin, for a while, and it's looking better now because the stock's down nearly $4 at 158.
Look at it coming right for our strike here, and we're having a nice little day.
Results were, they missed on EPS, but revenue was a little bit better at $6.9 billion.
You know, I heard someone say something about John Deere today that it sounded pretty intelligent. They love to under-report.
Right.
They always set low expectations for
They
themselves.
give really tight guidance. They're almost
Right.
like an Apple, where they kind of undershoot what the estimates are.
So they're an aberration. They're an aberration for most companies.
Look what this stock has
Right.
done today, though. Throw up a one-day, 1 minuter. Look at this.
Yeah.
The stock, it was down all the way
Which
to
would have been
154,
perfect for our put calendar.
up on the day, and now heading back towards our put
Right.
calendar, though.
And we did buy, for an example, we bought 3 lots of the 155 put calendars. We paid 49-cent debit for that, Kevin. What's
Yep.
it trading right now?
It looks like it's trading about, what we say, 49
49
cents?
is what we paid.
Looks like
for
it's
that.
trading about 82 cents. So we're making a little money here on a 3 lot.
Now, do you, with the market the way it is, Deer's down.
Here's what we'll do.
It's an earnings play, right?
Yep.
Because you only got 1 day to that short strike expires, and
How about this? We're going to put in an 85 offer, a little bit above the market. Let's see if this market drifts down to it. Remember, because you've got all day here. It's
Yep.
expiration days.
right on direction. It's not nearly right at that strike. You can always let that
But
short
it was
155.
earlier in the day, so
Exactly.
hope stay with it.
Yeah,
There we go.
Eternal.
And I think, Larry, that's the points we try to get across to our viewers is if you're doing an earnings play when you're making an options trade like this, treat it as an earnings play. Don't try to squeeze more juice out of that lemon that's already tasting pretty sweet at that time.
If you buy a spread for 15 cents and it gets to 50 cents, that's a triple,
Yep.
right?
Exactly.
If you did it 3 times, 5 times, or 150 times, it's a triple. Get out.
And we just you just filled on that at 85 cents, Kevin. So we're out of that one too. That was a nice trade. Nvidia's our last one before we move on to a discussion about Amazon. And Nvidia's had a nice pop. Stock's trading 160. It's come off its highs. Last night, I believe it was trading over 165.
Yes, it was.
Yeah,
it was up a lot more than it is right now. So.
And we did a unbalanced put butterfly in here, Larry. 1 by 6 by 5. Our short strike was 144. And we'll look at the closing order. It's basically trading zero.
Yeah, they're all trading a penny, which guess
Yeah.
what? Normally, I would say it's expiration day, but I'm going to tell you something about NVIDIA.
Wait, you just want to close your short
Yeah,
strike, though,
yeah,
right?
yeah.
There we go. Just a short 144 is where our risk is on that.
That's
Yep.
right.
If you can close that for 2 cents, we did that trade, Kevin, that balanced put butterfly for $1.72 credit. They beat on EPS 80 cents versus 78, and they beat on revenue, or just slightly on revenue. But
I don't care.
If you-
It's NVIDIA. Close it and lock in
Close
the
it.
profit.
And you're saying that
NVIDIA
because
is,
why? Because the last hour of the day,
Yep.
it could just.
There's,
And-
you never know, and that you've got a nice little day there. You got a nice little profit on a 1 by 6 by 5. Lock
Get out.
it in.
And think about this: the stock's off of highs that we saw pre-market
Yeah.
after the results last
Yeah,
night,
well off.
and it's slowly creeping lower. And Nvidia is one of those names. I mean, it was down previous to earnings. It was down 47% from highs in October over a 3.5-4 month
Yeah.
period. So this stock can move.
This has been not a friendly, gentle trader.
Right.
It's been vicious.
Yep. So
And-
we're out of our short strike, so we have no more risk, and we've got in case Nvidia does slam down $15, we've got some bullets down there at the bottom. But
Right.
We're out of it.
But the risk is gone.
Yeah.
We have no risk
Yeah.
in this position.
I mean,
Yeah.
that's an incredible lesson for anybody who's watching this because, all it takes is one time. This is a rip up, but one time.
Every stock has like a thumbprint, like a DNA, right? And this one we know can rip and move big numbers, both up and down. Take your profits.
Take your
and
profits.
Move on to the next battle.
Yeah, and most of the time, guys, and this is maybe a good lesson for our viewers out there, we're doing this live because these are example positions
right.
that we're trying to get strategies across to our viewers. But typically on something like that, when NVIDIA's up in the morning, I'm putting that bid in for those short puts in at 2 or 3 cents right away, right
Yes.
on the open, probably.
Yep.
So that's another good lesson. But let's move on to a discussion about Amazon, Larry. It's Fang Plus Friday, so we like to take a look at some of these names, and I think it equates well to that retail sales data that we got yesterday. That kind of clouded up the markets. And we're not seeing that today, but we've got Amazon down 0.75% today. Your takeaway is Amazon the Teflon company of the retail sector, or is consumer confidence, weather-related issues, tighter margins going to hurt this company?
Well, I think what's going to hurt it ultimately is that the regulators will finally catch up with not just Amazon, but Uber Tech and start to regulate them properly so they're paying taxes, so et cetera, et cetera. Who knows when that will happen? We know that regulators are always behind the curve; they're always a day late. But I think the best days are behind companies like Amazon.
Well, think about this, Larry, and you make a good point, like putting it into that basket with the other tech names, like the Google Alphabets and the Facebooks and Twitters. You might think Amazon's a retailer, but they're
not.
biggest business,
Infrastructure
growth
business.
AWS, and they're taking your data. They're using it, Kevin. So
Wait, what? Yeah, exactly.
But look, Facebook's coming out right now. They're negotiating with the FTC over a big fine from Cambridge Analytica, right? Privacy issues, privacy concerns, regulatory issues are coming.
When uncertainty becomes certainty, traders will love that. Even if it's a big number, put the number on it, and that is a relief.
You can work from that benchmark, and they can. Yes.
But the question I have, because Facebook's really ramping up their regulatory within their company. Getting rid of fake sites and fake news and all of that stuff. So they're ramping up a little bit of CapEx to take care of those regulatory issues. But what will the FTC, besides giving them a fine, whatever billion it is, what is the FTC going to say about moving forward and the more regulatory scrutiny that they're going to see?
Well, the good news is Facebook, I think, is going to be able to come out and say, look, we're already doing this.
Exactly.
Right? You can find us, but look what we're already doing. So, and then the big negotiation starts.
Yep.
We've already spent this much money changing this. Why are you finding us?
Did you hear? Here's a good little stat, because I was on the previous panel and I was doing a little bit of research. The biggest fine that the FTC has given a tech company has been a little over $200 million that they gave Google Alphabet in 2012.
That's nothing.
And Google Alphabet got fined $5 billion by the EU last year. So we've got a lot of catch up to do as far as regulations go and some of these privacy concerns. But now let's talk about the stock. Earnings already passed, right, guys? We got the stock trading 1605. Big news yesterday, they pulled out of New York City for their headquarters. 70% of the population wanted Amazon in Queens and their second headquarters created there. Politicians put a stop to that.
I'll tell you what, is there any person that's had a better week or 2 week run here than Jeff Bezos in terms of saying, there's a term out there that if you have enough money, you really don't have to worry about what people think or what they do or anything about that. This was a big play that he made to exit New York. Now the question is, the cynic in me says, is this a big poker hand he's playing? And are these talks with New York really dead?
I just think,
are they getting some bad press?
I think with all the other cities and all the other governments that wanted Amazon to come there, he probably just threw up his hands and goes, we've already got DC.
Their statement was harsh.
Yeah.
Amazon said, we don't want to work long-term in an environment like this.
Yeah.
You know what, though? I think, not now. I think we're all too clouded, jaded, as it were. But when you look at Mayor de Blasio and Como, no matter how you feel about them or think about them, I think years from now we'll look back and say, wow, those guys really had some, kahunas that tell, Amazon to get on their horse and get lost.
Boy, I think I agree with that, but I think that the history will say they were wrong to do that.
I think so.
Oh gosh, yes.
You think
that's
so?
still got to play. That's still got to play out. But I'm not sure what's going to be right or wrong on this.
Yeah.
But there'll be studies in finance classes about this for sure. So we have to wait and see that. But I created just a real quick strategy here, guys. If you follow us, and Rob's got us up here on the platform. Just creating an iron condor.
You skewed it.
Skewed it a little bit to the upside, a little bit, because my strikes on the put side, selling a put vertical, are $5 wide and only $2.50 wide on the upside. It's a March 1st weekly short iron condor, collecting $1.70 credit. Selling the 1660 calls, buying the 1662.5 calls. There's your short call vertical. Selling the 1550, 1545 put vertical. Now, this is the type of strategy you do if you think that Amazon's going to remain in a range moving in that. Larry, your assessment on something like that using an iron condor or another strategy that you might like on a name like Amazon.
Yeah, either that, iron butterfly, iron condor. I think what you put up here, just looking at it, eyeballing it, I mean, the risk reward proposition is there.
Yeah.
I mean, definitely, it's not for somebody who thinks the stock's going to stagnate. However, given what you're putting out, the risk reward is definitely It's there.
And you've got more risk to the downside, so you
Yes.
got to remember the $5 wide minus the 170 you collect.
Yep.
330 is the risk on that trade and the option buying power that gets reduced. But if you collect 170 to the upside, you've only got about 80 cents to the
cents.
upside of risk. So,
Looks like the calls are about, let's see,
75. 75.
Yeah.
Yep. We sold the 1660 calls.
1660 calls. Okay.
75% probability that finishes out of the money on the call side, and then the puts was the 1550, and that's 75%.
75 on
so
both
those are what we look at
Yes.
as far as probabilities, but that's just an example position if you think Amazon's just going to gyrate back and forth, even though it's down nearly 1% today. But that's a good way to take advantage of it if that's your assumption. All right, Larry's going to join us later on the show, but coming up next we got Face Off with Ken Rose. He's going to take a look at Apple because it's Fang Plus Friday. Stay right here on the TD Ameritrade Network. Fast Market will be right back. Welcome back to Fast Market. I'm Tom White, joined by Kevin Hinks. Kevin, let's do a quick market check. Off of highs.
E-minis off their highs, but still up about 0.7% here on the E-minis. NASDAQ is the laggard because why? The FANG stocks are not participating.
They're
and
negative
that's only
now.
up 0.25%, right?
Yeah, Google
Dow
Alphabet.
Industrial average up 329. The futures up 340, and the Russell up actually the strongest of the day, up 21, up 1.4.
Yeah, we're seeing a lot of the blue chips, whether it's Caterpillar, Boeing, all doing relatively well, and some of the banking stocks too are doing well. Including
Bangless rally.
Did you notice that? And I know we've got a discussion on Apple. Warren Buffett lowered his,
Yes.
or not Warren Buffett, Berkshire Hathaway lowered their stake in Apple by a little bit.
You think Warren's running out into the trading room right now going, who sold Apple?
Yeah, he might have been saying that because it wasn't him, it was actually somebody for his firm. All right, now it's time for Face Off. We're going to look at technicals versus fundamentals. And for that, we're bringing in Ken Rose. Ken, we're talking Apple today. How you doing?
Great. Happy Friday, guys. So looking at the chart here for Apple, a couple things kind of jump out at you here a little bit. First of all, Apple over the last 12 months is up a little bit over 4.5%, about even with the S&P 500. However, if you go from the January 3rd lows, Apple is up 18%. Looking at the chart here, we can see that the price is currently above the 20-period moving average. The 20 is above the 50-period moving average. However, currently the price and the 50 are currently moving sideways, indicating a stock that's trying to kick into gear up to the upside, but it isn't quite convincing. It doesn't really have a convincing uptrend at this particular point in time. Now, if you look at the chart here, I have some circles on this chart. This is a parabolic stop and reverse study. What the parabolic stop and reverse study is, it indicates potential changes in trend. This study indicated a change in trend from the downside to the upside on January 17th. I had a little arrow there that was pointing up to that. Now, the indicator has indicated that change in trend, but right now the interesting aspect of this is that the price has been moving sideways for 6 days. That parabolic stop and reverse indicator is coming right up to the price. So if that indicator jumps above the price, then that would signal Apple reversing and changing into a downtrend. If we look at the bottom of the chart, though, we can see that the volume oscillator is signaling strong volume, confirming the current move. So that's a positive. The first target to the upside is going to be the resistance level that we had back on February 6th at $177. That's also a Fibonacci level of 61.8, so we have a confluence of indicators there. The next higher target for the stock would be at the stock retracement level of 50%, which is also the target for a bull flag pattern, so we have a confluence of indicators there. That's at about 186. However, the stock has yet to break out of that flag pattern. It's been moving basically sideways here for 6 days, so technicians be looking for kind of a pop out of that area. With regards to support to the downside, we have a Fibonacci level of 78.6. That would be at about 160.95, with the next lower support level back at the January 14th bounce at about 148.56. On this stock, technicians would be looking for the parabolic stop and reverse to continue to signal an uptrend. They'd be looking for a completion of the bull flag pattern and a move up to that bull flag target of 186.95. However, the biggest challenge from a technical standpoint with Apple right now is this is a 6th day in a row of just sideways movement at this particular point in time. So that's, looking at the chart, I think those are some of the key points that technicians would be looking at.
Ken, so with rising volumes like you talked about, but obviously looking at your chart, and you said it, the activity on the stock is relatively muted. How long do you give this? Or what's the next trigger that you'd be looking at here?
Yeah, so when you have rising volumes and you have a stock that's moving sideways for 6 days, that's an indication of either accumulation or distribution from possibly hedge funds and other institutional investors. It could be a pause because the market is heavily affected by what Berkshire Hathaway is doing. I think Tom brought up a great point that's Berkshire Hathaway. It was a trader there, and I noticed that a spokesman for Berkshire Hathaway did come out and say, hey, those aren't the shares that Warren Buffett indicated to go into. Warren Buffett is still long on his original position. So I think that maybe helped investors to feel a little bit easier about things. But the 6-day movement to the sideways, it's most likely going to break one side or the other. I think technicians would be looking for that break to occur and to see what volume does on that break. If it's a break to the upside and volume continues to complement that could be a strong movement to the upside. If it's volume somewhat muted, it could be just a little bit of a pop to the upside and then further dribbling to the downside, or possibly the stock breaks to the downside. I think right now, looking for a break out of that 6-day sideways range and to see what volume is doing in relation to that. Strong volume on that break could bode well for a bullish move, and it could bode bad or well, depending on your position with regards to a bearish move to the downside right now. Some of the interesting things about Apple, I think that investors are also focusing on, they're looking at their service areas, their area of services. The margins are very high in that particular area. They're trying to draw attention away from some of their more mature products, the iPhone, the iPad, and the Mac, and draw investors' attention to their higher margin areas of services and subscriptions.
Yeah, I just from the chart, Ken, it does look like the stock over the last 6 or 7 days really starting to coil, and probably expect some type of move here shortly as it coils. But thanks for the technical analysis on Apple. Appreciate it. Have a great weekend.
Hey, thanks, guys. You too.
All right, coming up next is Cash Tags. Andy Swan, co-founder of LikeFolio.com, joins us to talk about Walmart ahead of their earnings on Tuesday morning. Stay right here on the TD Ameritrade Network. Fast Market will be right back. Welcome back to Fast Market. I'm Tom White, joined again by Kevin. Kevin, stocks are kind of stabilizing here.
About the same on the E-minis, about the same on the NASDAQ. The Russell up 1.5% though.
Yeah.
The Dow now up 330. Everything's about the same. Just a big solid update.
Okay, bonds and treasuries are now positive. Does that, this financial rally that we're seeing, like JP Morgan up 2.5%, Citigroup up 2.5%, do those start cracking now that we're catching a bid?
10-year 266.
Yeah, that 10-year yield's starting to slide here a little bit. We'll see if financials can hold on to their gains. But I noticed that we mentioned Berkshire Hathaway got out of just a
I got the numbers.
But they actually went into banks.
Right.
Warren Buffett was buying banks.
They rolled out of Wells Fargo and into JP Morgan and I believe Bank of America.
Okay. Yep.
Out of Wells Fargo.
That's why you're seeing a lot of strength there in the banks, I believe. But
here's the number, just for giggles. They sold 2.89 million shares of Apple, right, during late December.
Seems like a lot.
That gets them down to 249 million shares that they still have.
Exactly.
$39.4 billion worth of.
They have a big massive stake, so not really an outlier as far as getting rid just of a portion. But
whale.
Yeah. Now it's time to hit social media for our cash tag segment. For that, we're bringing in Andy Swan, co-founder of LikeFolio.com. We're taking a look at Walmart today, Andy. Welcome to the show. Happy Friday.
Yeah, happy Friday to you guys as well.
So Walmart, earnings on Tuesday morning. And this retail space has been the have and have-nots so far during earnings season in the early stages of 2019. What are you guys seeing at LikeFolio on data according to Walmart?
Yeah, Walmart, we're actually seeing some really positive signs for the company. So what's on the screen right now is purchase intent mentions for online ordering from Walmart. So this is people actually talking about buying things at walmart.com and through Walmart's online channels over the course of a 6-year period. And you can see a nice little uptrend has turned into something a little bit greater than that. It's actually accelerated over the last year or two. We're starting to see some real inroads with consumers by Walmart when they offer their, they have this new no membership necessary, zero shipping fees service. And we do think that based on what we look at from Walmart, that is cutting into Amazon. They're stealing some market share back from Amazon, and looks pretty good for Walmart in terms of the trajectory that they're on from an online shopping basis, which makes up an enormous part of retail spend, as we all know.
Andy, does Walmart have an identity crisis? Do they have a kind of a trouble attracting higher ticket buyers and things like that? Because, I admit, full disclosure, I go to Walmart, right? And I've traded the stock, and you can't argue with the prices and the margins of their goods.
Yeah, you're right, though. So there is a stigma against going to Walmart. I think that kind of disappears when Walmart comes to you and just drops a package at your door. And so that's what we're starting to see with consumers. We're starting to see consumer happiness moving up because people are actually satisfied and happy with the experience of buying online from Walmart. And, that chart that we showed earlier, very strong. Consumers are happier with the brand, and a lot of it is based on the fact that they don't have to go into those stores now.
Yeah, I think that's a big takeaway from Walmart's last report, which they saw really big. I think it was over 30% gains in that where you order online and you pick up at the store. They come and bring it out to your car. You're in and out in 2 minutes flat, and that's really picked up some steam. And they started advertising for that during the Super Bowl, too, with a pretty good ad. But for more on social media, let's get over to Jenny Horn, TD Ameritrade Network's own Jenny Horn. Good morning, Jenny.
Good morning, guys. Happy Friday.
Happy Friday.
An avid Walmart shopper.
Yes.
Avid shopper. Avid shopper.
Never. Would she say that?
No,
well, she lives in the city, so it's tough.
It is tough, but the online thing is huge, and I always have a hard time making the parallel between Amazon and Walmart because Amazon is such a great website, but recently I'm moving, so I've been looking for furniture, and Walmart's website is fantastic. So I've been pleasantly surprised looking at their website, and that's just something I've come across recently, and I saw that completely on social media this morning. So
yeah,
it's
we talk about scale all the time, Kevin and I do. Walmart's scale allows them to actually have better pricing on a lot of items that
margins.
Absolutely, yeah.
It's hard to compete with their margins.
Yeah,
it is. So our first tweet says, Walmart doubled. Who would have thought this is the one making my Friday? Booyah. So they're right around their weekly highs today. What are you watching going into earnings next week?
Just from that retail sales data that we got yesterday, that was underwhelming to say the least.
Right.
It was miserable to, if you want to really take a stab at it. But I look at going into the latter stages of 2019, what their guidance is going forward. We've seen that so many times this earnings season is a company can beat on EPS and revenue, but they guide softer moving into 2019. Their stock takes a beating sometimes. Kevin, you taking a look at that?
This stock is basically right back to the price it was midday the last time they had earnings.
Yeah.
If you look on the chart.
And the
look
stock
at that
cratered,
right there.
Yeah, stock cratered last quarter.
Yeah,
too.
and then the stock went from about 99 and change down to, right near $85 after that. So am I watching? I think this is one that you got to really watch the earnings and then trade it post-earnings.
And typically Walmart's not like a big mover post-earnings, but 3 out of the last 4 quarters, it's moved pretty significantly outside of its 1 standard deviation range, so watch that too.
And clearly it's not sell-off resistant if it fell that much in December.
Exactly.
Right.
All right, you got another tweet for us?
I do. Our next tweet is from Venki, who says, so Walmart wants Overstock.com retail. So I'm seeing these rumors on social media today that are super interesting that Walmart potentially wants to purchase Overstock. These are completely speculative. But why exactly would they want to get into this space? How could this help the company?
Andy, do you guys have any data on that you would look at or compare Walmart to whether it's Target or something like an Overstock where it's got it's a niche player in that online sales where this might actually be a good purchase if this actually came to fruition?
Well, we really don't track in terms of, potential acquisition news. We try to stick with what actually happens. I'll say that what Walmart's done with this company called Fanatics is really interesting, where you can buy licensed sports apparel online through Walmart. They've done some really cool stuff. I think they got a self-driving delivery service that they're working with or acquiring. And so I know Walmart is being aggressive in their partnerships and potentially acquisition strategies. But in terms of overstock, that's a company we track. And, consumers are fairly happy with it. I wouldn't say anything standing out to me that would make me think, wow, Walmart would really benefit on a consumer brand perspective from owning that company. So I think that's really speculative and kind of outside of my wheelhouse. But what I will say is the inroads that Walmart's making with consumers in online spending actually makes me think that a acquisition of a traditional online channel would be less likely rather than more likely.
Yeah, and especially after a little bit of the outcomes from the Flipkart investment that they did over in India, that's actually put a cloud over the results the last couple quarters too. So maybe stay away from that M&A activity. Stay off the headlines.
Earnings Tuesday before the open.
Tuesday before the opening. All right, Andy, have a great weekend. Thanks for all the content on Walmart ahead of their earnings from Folio. Take care, buddy.
All right, you too.
All right, Jenny Horn, you got virtual trade coming up with Scott Connor. What are you guys talking about today?
So no more butterflies. Today we'll focus on diagonal spreads.
Love butterflies.
Yeah, we're moving away from that today. We'll look at the essentials of diagonal spreads, price selection, and then the risk profile.
Awesome. That sounds great. Thanks so much, Jenny. Have a great 3-day weekend. You're going to enjoy it here in the city. Stay warm. Coming up next, we're going to take a look at a couple example trades, one in Apple and one in Walmart. Stay right here on the TD Ameritrade Network. Fast Market will be right back. Welcome back to Fast Market. I'm Tom White, joined again by Kevin Hinks, and we've also got Larry Shover back with us. Guys,
a little softer, but nothing really to mention.
Did you notice that the financials are basically holding us up today? They're, like we said, the financial
Look
sector.
at Citi up 2.6%.
All up over 2.5%. Fang Plus now down 0.4% on the day, led by Facebook, now down 1.7%, Kevin. Amazon weakness, Apple weakness, Netflix. It's Fang Plus Friday. It's a sad day for Fang Plus today because they're all down pretty significantly.
Good day to get in them.
Yeah,
right?
If you want to get long, for sure.
That's right.
Yeah, that's a great way to look at it. Now, let's get into a discussion about a couple trades. Because it is Fang Plus Friday, we're going to look at Apple to start. Stock's down 75 cents here, and I think that has something to do with there were some reports, some of the funds, including Berkshire Hathaway, getting out of some of their stakes in Apple.
Yeah.
And it wasn't just Berkshire Hathaway. It was Tiger Financial, it was Jana Partners. There were some other ones that came out. They have to report their quarterly disclosures, and we saw some investors getting out of there. Like Ken Rose did on the technical analysis, the stock's been sideways basically for the last 6 sessions after a nice ramp up.
Yes.
Still up 7.5% this year, so still having a nice 2019, but at the same time, their last earnings report, not that positive, even though the stock rebounded from those December lows. What are you thinking here, Larry, when you look at Apple, you look at strategies, the stock's kind of stagnated around this 170 level for the last 5 or 6 sessions?
Yeah, I mean, that's one of the few companies that actually really I love. I love Apple, but I'm a trader, so I don't really care what I like or what I don't like. What
I like more than Apple? Money.
Yeah, so earning it, and
Exactly.
I think it's worth. I scanned the options chain, looked at the end of March 29th.
29th weekly cycle,
Yeah.
42 days to expiration. Okay.
And I'm convicted. I have a conviction that this stock's going to back off a little bit. Not because it's a bad stock, but I think just in general the market's got ahead of itself and it's worth the risk. So I looked at the 160, 170 put butterfly.
Okay.
A little expensive.
So you're buying one of the 170s, selling 2 of the 165s, and then you're buying one
The
of
160.
the 160s. So $5 wide, 1 by 2 by 1. There's your butterfly. It's roughly trading around 70-cent debit on that particular trade, with the ability for that thing to expand to $5, the width of the wings, right?
Yeah, $4.31 profit potential. Between now and the end of March, and that's why I looked further out as opposed to like something that's expiring next week. So I think there's a chance for that to breathe a little bit. And what I mean by that is that the stock, even down $5, $6, $7 from here, you probably could make some money on that.
Yeah, and you think about this the risk reward, risking only 70 cents to make potential $4.30 is what's key. Now, Kevin, let's move over to the discussion on a butterfly. And it's not only a directional trade based on you want it to go to that short body of this strategy, but also it's a timing trade, isn't it?
Yes. You've got to be patient on a name like this because, it's not going to. Let me put it this way.
Yeah.
If you're buying this for 70 cents, your earnings expectations of $4.30 are naive and not realistic.
That's right.
As what I want to make sure you understand.
Yes.
So that debit that you're taking, if that goes up to $1.50, what do you do on that trade?
It depends on when.
Yeah.
Well, it depends on when it happens.
That's right.
Right?
So, remember, the earlier it goes into that area, the less money you're going to make.
That's
right.
Because the other options, the options that should be going down into zero, will hold premium into the very end.
Yeah, and that's why I kind of made this a timing trade or a discussion about timing trade, because this thing's not going to really start expanding until we get towards the expiration cycle for this particular trade. It might expand a dime, 15, 20 cents, maybe 30 cents, but you're not going to see it move over maybe $1.50, $2 until like the last couple of days till expiration.
I'm so glad you brought that up because I think if we put that trade on and the stock drops $5, you're like, hey, the strategy only went up by a dime, you're going to be disappointed. But you're right. It's the decay that we won't see until 2 weeks leading to expiration.
That being said, Kevin's kind of changed the
I changed the dates to 2 weeks shorter.
Okay.
And it looks like it's now 81, right around 80 cents, so another dime, but you're 2 weeks closer, where it might make more money if it went into that range.
And I think this goes back to what are your expectations over a specific duration right
Exactly. And for me, it's like I'd rather buy the time, the extra week or two.
Right.
And this is one of those strategies that I would put on and just try my best just to forget about it, not look at Apple every single day, not look at the strategy, just wait. You're buying it, not a discount, but you're buying it on the cheap.
Yeah.
Hoping for something
good risk
But make no
reward.
mistake, what Larry said there, that extra 2 weeks, right? That for us to concentrated 2 weeks closer cost us a dime.
Yeah.
Maybe 11, 12 cents in
but
terms
not
of
bad.
premium.
That shows you how slowly these things expand in value too, because Kevin cut 2 weeks off of that trade and it only went up a dime in value. So with the stock at the same price. So Kevin will go ahead and put that in a couple times for us just to kind of manage that, and we'll see what happens with that. Now let's move over to a discussion about Walmart. We just talked about it with Andy Swan from Likefolio. And Walmart's, hovering just under, $100 a share.
Yep.
Their shares are up 6% this year. And looking at what is expected, because the earnings come out on Tuesday, Kevin, before the market opens.
So we're not even going to look at this week.
So we don't have any
obviously.
anticipated market maker move up there on the trading platform because volatility is not elevated in our near-term cycle because those expire today. But volatility is elevated in that February 22nd weekly cycle with 7 days.
And 99.5, it looks like it's trading about 210 and 211, so about 420.
Yep, and you got some time decay in there. So maybe the anticipated moves probably $3.50 or something along those lines, plus or minus.
Yeah, I would say it's a little higher than 3.5, but under 4.
Yep, and what Kevin's getting at, if the current at the money strike is 99.5, it's worth about $4.25 on that, but you do have 7 days to expiration.
Right.
So there'll be some time decay or theta that comes out of that. So that's why that $3.75 might be a good number.
But that's a good way for
Plus
what
or
Tom
minus.
is talking about, to when you're trying to look at an expected move without seeing it on the Thinkorswim platform, that'll give you a little hint of what it's going to be
variance
close to.
in its purest form.
Right.
You don't have to look at an index. There you go. That's the variance.
Yep. So strategy-wise, Kevin, what do you look at? See, I look at Walmart, and it's 3 out of the last 4 earnings cycles. It's really moved outside of its expected range.
Yes.
You had big moves.
Big moves.
Big moves in the stock. Sometimes I might look at a name like Walmart and say, I'm going to wait until after earnings. If it sells off pretty significantly, maybe I want to get long a calendar to the upside. Or if it goes really high, maybe I want to buy a put calendar after volatility gets hit out of this particular
Last quarter, that's exactly what I did. I waited till after the earnings report and then traded it on the downside because, frankly, I thought it was a pretty good earnings report, and they hit it hard because they didn't grow enough.
Does that work for you? I mean, like, is that what you typically do? Like, wait till after?
Sometimes
it depends.
It depends on
Right.
how much volatility is elevated in this. If I think that Walmart's going to move more than that $3.75 that we're expecting, then I'll probably wait. If I think it's going to stay, if volatility is going to get crushed and it's going to probably move within one standard deviation, then maybe I'll do something like a long double diagonal or something along those lines. But that's a way to look at it.
Or you get in a situation like this where it's coming down and you kind of fade it by selling put verticals, right?
Yes.
And wait for a little.
So that's what we might do in Walmart. Just wait until earnings come out on Tuesday. Maybe trade it Tuesday. Show an example trading there. But that does it for us today. I'd like to thank Larry Shover for joining us once again. Always great stuff. And Kevin Hinks. Hey, everybody, have a great long weekend. Tune in on Tuesday at 10 a.m. Central Time, right here on the TD Ameritrade Network.